Well, dear learners, I welcome you all in this session on final accounts. So far, we have been discussing about the various adjustments to be taken care while preparing the financial statements of an enterprise. As we have already discussed that financial statements helps the individual or the organization in order to know the exact profitability and financial position, because in the era of competitive business environment we need up to date information, and these informations must be true and fair, because when the information furnished by the management or by a business enterprise are not updated and are not true and fair, in such a situation the decisions taken by the interested party or by various stakeholders will not lead them in the right direction. Therefore, in order to see the true and fair financial and profitability positions, let us now understand the various adjustments which are to be taken care while preparing the financial statements. So, in continuation with that, the next adjustment is pertaining to the drawing of goods by the proprietor. Well friends, as you all know that whenever the proprietor is withdrawing either goods or the cash from the business for his personal use is called drawings. So, here in this particular situation, when the drawings is made in the form of goods, not in the form of cash, rather in the form of goods, then how to deal such an item while preparing the financial statements we will discuss. So, well friends, the journal entry for this item is very clear that drawing account will be debited to purchase account or to cash account. So, here in case if the drawing is made in the form of goods, then drawing account debit to purchases account, this journal entry will take place, and in case instead of withdrawing the goods from the business, if the cash is withdrawn by the proprietor for his personal use, in such a situation the journal entry would be drawings account debit to cash account. So, here it is very simple that whenever the drawing is made in the form of goods or in the forms of cash. So, here the account of proprietor is debited, because whenever the proprietor account is credited, in that case the capital of the proprietor gets increases. But here when the drawings is made by the proprietor, in such a situation the amount of the capital must decrease. Therefore, in order to decrease the capital balance, we generally debit the drawings account or capital account. Both are one and the same thing, because ultimately when we transfer the drawings balance, it will be transferred to the capital account and the results will remain the same. The treatment in final accounts is like this: when the drawing is made in the form of goods. So, here in such a situation the purchases of the business concern will be reduced by the same amount. It will be deducted from the purchases and will be deducted from capital on the liability side of the balance sheet, because whenever the drawings is made, it means the same amount of drawing is reducing the amount of capital in the business firm. So, the treatment is that first of all it will be deducted from the purchases and will be shown in the debit side of trading account, or we can make a treatment that without deducting it from the purchases, we can show it in the credit side of purchasing account instead of reducing it from the purchases account in the debit side of trading account. Then this amount will also be deducted from the capital and the net amount of capital will be shown in the liability side of the balance sheet. Then the next adjustment is charity in the form of goods. So, well friends, when the charity is given by the business enterprise in the form of goods, then of course, when the goods is going out, the amount of purchases in the business concern will also get reduced. So, here when the charity is given in the form of goods, so it will have its implication on the purchases. It means the amount of purchases will automatically get reduced by the same amount, and then the charity is given. So, here the charity is an expense for the business, and as per the rationale of the nominal account, charity will be debited. So, here in this case the journal entry would be charity account debit to purchases, because charity is an expenses and all the expenses, losses, revenue and incomes comes under the nominal account. We simply applied the rationale of the nominal account and accordingly charity account will be debited to purchases, because the charity has been given in the form of goods. Therefore, the stock of goods will automatically get reduced by the same amount. Then the next one is goods distributed as free sample. So, this is same as the charity is given in the form of goods. So, here in place of charity, the samples have been distributed free of cost and the goods distributed as free sample. So, sometimes in order to promote the sales of the business, some sample of goods are distributed as free sample. So, this distribution of free sample of the goods is an expense for the business. Therefore, we will debit it and we will credit the purchases account, because the samples have been distributed in the form of goods. So, it will reduce the balance of the goods, it will reduce the balance of the purchases account. So, here the journal entry would be free samples account debit to purchases. So, the impact of this adjustment on the final accounts would be as follow, because here the goods have been distributed as free sample. So, here again either we can deduct it from the purchases account and the net amount of purchases will be shown in the debit side of trading account, or what we can do is that the amount of goods distributed as free sample can also be shown in the credit side of trading account. This is one aspect, and the another aspect is because the distribution of samples in the form of goods is an expense for the business. So, therefore, all the expenses and losses have to be debited to the profit and loss account. Therefore, this must also be reflected in the debit side of profit and loss account. So, this was the treatment of goods distributed as free sample. Then the next one is use of goods in the business. So, well friends, what happen sometimes that goods from the goods meant for sale is used in the business for business purpose. It becomes an asset for the business. Say for example, if we are into a manufacturing business. So, here when sometimes what happens that, or we are into a trading business, we are into the trade business of, say for example, furniture. So, what we did is that out of the furniture purchased for resale purpose, what we did is that some of the furniture we have used for the entertainment of the customers. So, whenever the customer comes to the shop, so we have used the furniture for entertaining the customers. So, now this furniture is not meant for sale. This furniture now we are using for the business purpose. So, now this furniture has become an asset for the business. So, here the journal entry would be furniture account debit to purchases, because when we use the sum of the amount of furniture for the business purpose, over a period of time it becomes an asset. So, any asset has a debit balance. So, therefore, we debit the furniture account, and because now the remaining goods which is meant for the sale of the business, that goods has been reduced. So, therefore, we credited the purchases account, because when we debit the purchases account, it means the amount of goods is increasing. So, by using some of the furniture in the business, it will reduce the amount of the goods, it will reduce the amount of the furniture if we are into a furniture business. So, therefore, we credit the purchases account. So, the entry would be furniture account debit to purchases, and the treatment of this item as far as the preparation of the financial statements is concerned. So, very simple. First of all, it will be deducted from the purchases, and the net amount of purchases will be shown in the debit side of trading account, or what we can do is that we can show it in the credit side of trading account also. So, instead of deducting it from the purchases account, we can directly show the amount of this goods which we have used in the business in the credit side of trading account, and now this furniture has become an asset for the business, it must also be shown in the asset side of the balance sheet also. Then the next item is contingent liabilities. So, these are the liabilities which are not the liabilities for the business on the balance sheet date, but may turn into liabilities on occurrence of some happening. For example, if some litigation is going on against the firm and the firm do not wins the case, it means when the firm loses the case, it will turn into a liabilities. So, the treatment of contingent liabilities while preparing the financial statement is that it does not impact the financial statement of the business, rather the amount of contingent liabilities is shown outside the balance sheet as a footnote, that there is a litigation which is going on in the business of so and so case. So, that reporting of that particular event is necessary outside the balance sheet as a footnote, but as far as the contingent liability is concerned, it does not impact the profitability or financial position of the business concerned. Then the capital expenditure treated as revenue expenditure. So, there are some expenditures. When we treat the capital expenditure as a revenue expenditure, then this mistake need to be rectified, and then accordingly it need to be treated while preparing the financial statements of the business. So, here are few examples of the capital expenditures which were treated as revenue expenditure, and accordingly they were treated while preparing the financial statement. The first one is wages include rupees 2000 spent on installation of a new machine. So, here when some wages is incurred on the installation of a new machine, so generally it increases the cost of the machine. This is the capital expenditure which will ultimately enhance the cost of the machine. So, this amount of wages which we have spent on the installation of a machine cannot be treated as a general wages and cannot be shown in the debit side of trading account. Rather, this amount of rupees 2000 which we have spent on wages for the installation of a machine must be included in the cost of the machines and will be subtracted from the wages, and then the net amount of wages will be shown in the debit side of trading account. Then the next one is goods purchased of rupees 5000 for the construction of building was recorded in the purchases account. So, dear learners, my very sincere advice to you is that you must be in a position to make a clear cut distinction what actually has been purchased. So, if the goods in which we are dealing with has been purchased, so only that merchandise, only that goods can be considered under the head purchases. Otherwise, if we are buying the goods of rupees 5000 or of any amount for the construction of building, so it is a capital expenditure which will ultimately enhance the cost of the building. So, that expenses cannot be recorded in the purchases account. So, here the treatment of such item is very simple, that first of all it will be deducted from the purchases account, and then the net amount of purchases will be shown in the debit side of trading account, and then the amount of building must also be increased by rupees 5000, and after adding this amount of rupees 5000 in the cost of the building, then the total amount must be shown in the asset side of the balance sheet. Then the next one is rupees 2000 spent on erection of cycle shed was recorded in repairs account. So, when any expenses is incurred on the repairs of the erection of a cycle shed, so that cannot be treated as general repair and cannot be debited to the profit and loss account. So, it is very simple that it will be subtracted from the repairs balance and will be added to the cost of the cycle shed, and the treatment of this item while preparing the financial statement is very simple, that first it will be subtracted from the repairs, and then the net amount of repairs will be shown in the debit side of profit and loss account, and then this amount of rupees 20,000 must be added to the cost of cycle shed, and after adding this amount, the total amount of cycle shed should be shown in the asset side of the balance sheet. So, this is how we make a treatment of capital expenditures when they are treated as revenue expenditures. Then the next one is goods sold omitted to be recorded in books. So, when we made a sale of goods, but finally we omitted to be recorded in the books of the account. So, the treatment of this item as far as in the preparation of the financial statement is concerned, it is very simple, that it will be added to the sales and then the total amount of sales will be shown in the credit side of trading account, and this amount will also be added in the balance of the debtor, and then the total amount of debtors must be shown in the asset side of the balance sheet under the head current assets, because the debtors are the current assets of the business. So, the journal entry for this transaction is very simple: debtors account debit to sales. Because why we credited the sales account? Because we will have to credit the sales account, because we made a sale and we forgot to record it in the books of the account. So, therefore, in order to enhance the amount of the sales, sale must be credited, which we have actually credited, and debtors being an asset have already, and all the assets have and debit balance. So, keeping in view the rationale of the real account, debtors accounts has been debited. Then next one is goods purchased omitted to be recorded. So, this is as simple as the previous item. So, it will be added to the purchases account, and then the total amount of purchases must be shown in the debit side of trading account, and it was omitted to be recorded in the books of the account. So, here it must also be edited, to the creditor, and after adding this amount in the creditor balance, then the total amount of creditors must be shown in the liability side of the balance sheet, and the journal entry of this transactions would be purchases account debit to creditors. So, this is just as reverse to the above items which we have discussed just now. Next one is sales of goods on approval basis. So, sometimes goods is sent to customer with the condition that if they like it, can retain the same, or if they do not like it, then the same amount of goods can be returned to the business. So, such transactions cannot be treated as sales until it is finalized by the customer. So, here if we treat this as sales and later on we came to know that this goods was not liked by the customer and ultimately it was returned by the customer to the, and finally it was returned by the customer to the business. So, the journal entry for this adjustment would be sales account debit to debtors. So, here because we treated this transaction as original sales, whereas this sales was made with this condition that if the customer like it, can retain it, or if the customer does not like it, he can return the goods to the business. So, we treated this transaction as a original sale, and accordingly we made the entry, but later on we came to know that the sales was not made, the sales could not take place, and the goods which we had sold to the customer on the condition that if they like it, can retain it, or if they do not like it, they can return the goods. So, that was finally returned by the customer to the business. So, now the reverse entry we will have to pass, and for that we will have to debit the sales account. Generally sales account is debited, but now the goods is coming back, goods is returning to us. So, therefore, we will have to reduce the balance of the sales. So, accordingly we will have to debit the sales account, and we will have to credit the debtors account also, because debtors is an asset, and as per the rationale of the real account, all the assets have a debit balance. So, therefore, we generally debit the assets account, but now the debtors are no more, because the sale actually could not take place. Therefore, we will have to reduce the balance of the debtor, and accordingly we credited the debtors account. So, this will be deducted from the sales in trading account, because now the goods is back to the business. So, our sales has come down. So, therefore, we will have to deduct it from the sales, and then the net amount of sales will be shown in the credit side of the trading account, and it will also be deducted from the debtors, because now there are no more debtors, because the goods have returned to the business, the goods have come back to the business. So, therefore, the same amount will also be deducted from the debtor, and then the net amount of debtor will be shown in the asset side of the balance sheet. So, cost of goods which was sold to the customer with that condition. So, the cost of goods has now returned to the business. So, therefore, the cost of goods must also be added to the closing stock, and accordingly after adding the cost of the goods sold, it must be shown in the credit side of the trading account and in the asset side of the balance sheet. So, it will be reflected at 4 places. The first one is it will be deducted from the sales, second one is it will be deducted from the debtors, and the third one is the cost of goods sold will be added to the closing stock, and then the net amount will be shown in the credit side of trading account. And the fourth one is after adding the cost of goods sold into the closing stock, then the total amount of closing stock will also be shown in the asset side of the balance sheet. So, here there are items, that the items which we have discussed so far pertains to the items which are shown outside the trial balance, which have been provided as an additional informations as adjustments. But when these items are not shown in the adjustments, so when these items are provided in the trial balance, then how these items will be dealt. So, we will just have a look on that when these items are shown in the inside the trial balance, then how these items will be treated. First one is closing stock. So, if closing stock is given inside the trial balance, then the closing stock can also be shown only in the asset side of the balance sheet. Then it cannot be shown in the credit side of trading account. Then the second one is outstanding expenses. So, if outstanding expenses are shown inside the trial balance, then outstanding expenses can only be shown in the liabilities side of the balance sheet under the head of current liabilities. It cannot be added to the concerned expenses. It will only be shown in the liability side of the balance sheet. Then the third one is prepaid expenses. So, if prepaid expenses are provided in the trial balance, then prepaid expenses can only be shown in the asset side of the balance sheet. So, I have already advised and made it very clear to my learners that if the items are shown as additional information in adjustments, then it will have its impact minimum at 2 places. But when these items are provided inside the trial balance, then these items will have only a single impact. So, now we are discussing these items when they have been provided inside the trial balance. So, the fourth one is outstanding income. So, when outstanding incomes are provided inside the trial balance, then the outstanding incomes can only be shown in the asset side of the balance sheet only. Fifth one is income received in advance. So, well friend, when the income received in advance is provided inside the trial balance, then it will be shown in the liabilities side of the balance sheet only. Nowhere it can be shown except in the liability side of the balance sheet. Next one is depreciation. So, when the amount of depreciation is provided inside the trial balance, then the amount of depreciation should be debited either to the trading account or to the debit side of profit and loss account. So, when the depreciation is charged on plant and the business concern is a manufacturing concern, then the depreciation on plant will be charged from the trading account. It will be shown in the debit side of trading account. So, students be very careful that they must know that if the business concern is a manufacturing concern and the information pertaining to the depreciation belongs to the plant, in such a case depreciation cannot be shown in the debit side of profit and loss account. Depreciation can only be shown in the debit side of trading account instead of profit and loss account, because in such a situation the depreciation becomes the direct expenditure and all the direct expenditures being the integral part of the trading account must be charged to the debit side of trading account only. Then the next one is interest on capital. So, if interest on capital is provided inside the trial balance, it can only be shown in the debit side of profit and loss account only. Then the next one is interest on drawings. So, when the amount of interest on drawing has been provided inside the trial balance, then such amount can only be shown in the credit side of profit and loss account only, because interest on drawing is a revenue for the business. Therefore, all the revenues are shown in the credit side of profit and loss account. Then the next one is interest on loan. So, interest on loan is an expenses for the business. So, accordingly it must be shown in the debit side of profit and loss account only if it is given in the trial balance. Then the next one is bad debts. So, when the amount of bad debts has been provided inside the trial balance, then the amount of bad debts can only be shown in the debit side of profit and loss account only, as the amount of bad debts is an expense or loss for the business. Accordingly, it must be debited to the profit and loss account only. Then the next one is provision for bad debts. So, provision for bad debts is subtracted from the amount of debtors, and after deducting this amount it must be shown in the asset side of the balance sheet only. Then the next one is provision for discount on debtor. So, provision for discount on debtor is an expense or loss for the business. Therefore, it must be shown in the debit side of profit and loss account only. The next one is provision for discount on creditor. So, this is an income for the business and it must be shown in the credit side of profit and loss account only. Then the next one is manager's commission. So, manager's commission, after calculating the amounts of manager commission, because this is an outstanding commission for the business, because till the final accounts are paid, it is only calculated, it is yet to be paid. Therefore, it becomes an liability for the business. Therefore, it must be shown in the liability side of the balance sheet under the head current liabilities. Then the next one is abnormal loss. So, abnormal loss must be shown in the debit side of profit and loss account only, as all the losses are shown in the debit side of profit and loss account. Then the last one is drawings of goods by the proprietor. So, very simple, drawings of goods by the proprietor, it reduces the balance of the capital and accordingly it must be subtracted from the capital, and then the net amount of capital must be shown in the liability side of the balance sheet. So, this was all about these adjustments, that when such adjustments are provided as additional informations outside the trial balance, then these adjustments will have minimum impact at two places, or if these items have been provided inside the trial balance, then the impact of these adjustment, impact of these items will be only at one place while preparing the financial statements of the business. So, this was all about this lecture. So, I extend my sincere thanks for bearing with me. I hope that you all might have enjoyed this lecture to the fullest extent. Thank you very much.